Have you ever noticed how most people don't feel poor, but also don't feel safe? They earn a decent salary, their bills are paid, and life looks stable on the surface. Yet one unexpected expense, a medical bill, a job change, a rent increase, suddenly creates stress that feels out of proportion. That discomfort isn't random, it's structural. Let's walk through a familiar situation. Imagine a 28-year-old living in the US or Western Europe. After tax, they take home about $3,200 a month. Rent or a mortgage eats up $1,200. Car payment, insurance, and fuel take another $450. Student loans or personal EMIs, $300. Groceries, utilities, phone subscriptions, $600. Credit cards quietly absorb $200. What's left? Roughly $450. That money feels like freedom, so it disappears. Restaurants, travel plans, gadgets, lifestyle upgrades that feel earned. Here's the uncomfortable truth. The biggest financial mistake most new investors make isn't not investing. It's investing emotionally, without understanding risk. People often believe investing means choosing between doing nothing or taking a big chance. That belief pushes them towards speculative stocks, crypto hype, or complex strategies they don't fully understand. Let's put simple math on that. Suppose someone invests $300 a month into something volatile. Excitement? Some months it's up, some months it's down. After 3 years, the account balance is $11,000, barely ahead of contributions. Now compare that to a calm, boring approach, returning a modest 6% annually. Same $300 a month. After 3 years, about $12,500. No drama, no stress, no guessing. The difference isn't intelligence. It's psychology. The human brain hates slow progress. We overestimate short-term opportunity and underestimate long-term consistency. We want movement, even if that movement is sideways. Financially intelligent people think differently. They don't ask, how much can I make this year? They ask, how little risk do I need to take to move forward? Their first priority isn't growth, it's stability. That's why the first low-risk strategy isn't even about investing. It's about liquidity. They quietly build cash buffers that sit in high-yield savings or money market funds. Not to get rich, but to avoid debt when life happens. Once that base exists, they move to ownership, not speculation. Broad market index funds. Nothing exciting, just participation in the overall economy. They understand something subtle. You don't need to beat the market when you are the market. Then comes income predictability. Some allocate a portion to dividend-paying assets, not because dividends are magical, but because they reinforce patience. Cash flow arriving regularly changes behavior. It reduces panic. Another piece is capital protection. Government bonds or high-grade bond funds don't impress anyone at dinner parties, but they reduce volatility. They act like shock absorbers in a financial system that regularly hits potholes. Finally, there's automation. Not strategy, behavior. Investing on schedule, regardless of headlines or emotions. This removes decision fatigue and protects against timing mistakes that cost far more than fees ever will. Ignore this approach long enough, and the cost compounds quietly. Not just in dollars, but in stress, missed opportunities, delayed freedom. But follow it patiently, and something changes. Money stops feeling fragile. Investing stops feeling like gambling. And financial decisions become calmer, not urgent. That's the real goal. Not getting rich fast. Not beating anyone else. Just building a system that works while you live your life. If this way of thinking helped you see investing more clearly, consider subscribing to the channel.